update from me. Just firstly, a few notes on the turbulence in the banking sector. Look, while there's still a lot in flux and a lot of potential scenarios playing out, I guess just a few comments on sort of how we're seeing it at the moment. So not to play down the risk at what happened at Credit Suisse and SVB. What we saw with SVB was really an issue with the liability side of the balance sheet. So, but when we're looking at the liability side of the balance sheet for banks, that means deposit flight. So this in turn led to issues on, as we all understand, on the asset side, forcing them to really sell off some of those unhedged assets. So as far as we know, this is not replicated widely across the US banking system. And it's more so concentrated in that more lightly regulated regional banks. So this is far different from what we saw in 2008, where we saw sort of Lehman go down, which led to really big falls in asset prices, a collapse in the housing market. Banks were over leveraged, so which really called into question the solvency of the bank. So this is a very different situation from that. So I guess the good news is, being a liability issue rather than an asset issue, the regulators are much better equipped to obviously deal with that. We've seen the regulators act quite decisively and act quite quickly. They've got tools such as deposit guarantees, the repo facility, extension of central bank loans, all which have been put into place. So if a SVB-like situation continues to play out in some of the smaller regional banks, then look, it won't be great for market confidence, but nonetheless, the regulators have the tools to act and act pretty quickly on that. So how do we see this playing out, from here on in? I guess three possible scenarios. Firstly, the good scenario, and really the best case scenario, is the SVB collapse leads to possibly a few more issues around some of the smaller regional banks. But, as I said, the regulator steps in really quickly, reassures confidence. So we see a drop in the risk premia, credit conditions ease, and the US resumes its process of lifting interest rates, beginning with this week. So, in fact, we've seen BBB corporate spreads. While they did blow out a little bit, they're still well below, or at least below where the Fed started to lift interest rates. So got to a high of 2.1% back in the mid 2022. And now it's about 1.95. So we haven't seen that blowout in spreads at the moment. So I guess credit conditions still remain okay. I guess the market's taking a view that it's more confined to some of the more idiosyncratic issues at the bank. So the second scenario, so we continue to see problems emerging in the financial sector, but they are confined within the US. So what happens is then the US banks start to lose a little bit of confidence. They start to withdraw credit from the US market, and that drives down demand in the private sector. So conditions, around credit remain very tight. So I guess that impacts demand. So what does the Fed do there? In that case, we possibly do see that one more rate rise, which Richard touched on, is priced in for this week. But then at the back end of the year, we start to see rate cuts. In fact, the market at the moment, looking at it this morning, bond market's pricing in one more rate hike this week, followed by 3 to 4 rate reductions in the US in the second half of this year. So it's been quite a move in terms of interest rate expectations. In fact, the RBA, the bond market's pricing the RBA to leave rates flat from here on in, and potentially one cut in the second half of this year. So just interesting how the bond markets move to that. And the third scenario, which we see is unlikely, but it's the worst case scenario, the SVB collapse does turn out to mark the start of a new global financial crisis. SVB is an early indicator of some of the vulnerabilities that are in the financial system. So what the central banks do, they step up their liquidity, but then this leads to a loss of, this doesn't reassure confidence, and we see a significant tightening in credit conditions and hence a recession. So where do we sit? Clearly, look, it is a very fluid situation, but as things stand, we're currently between that first and second scenario. And we see that as the most likely outcome, with the third of really a distant tail risk at this stage. So in other words, a lot of the impact is going to be felt within the US. It's going to be, a hit to demand there, possibly a change of tune in terms of where US monetary policy goes. But elsewhere, the knock-on effects we don't see as impactful. So that's currently where we sit. So look, watching very closely. But obviously, the other news is around sort of Credit Suisse and what happened there over the past few weeks. I think it's really important to note that the European banks are very tightly regulated, much like our banks. And what they typically operate is very strong liquidity coverage ratios. So according to Citigroup, in aggregate, the European banks hold about 163% LCR. So these are high quality assets required to be held in very liquid instruments, and they typically hold this either in cash or government bonds. They're required to be marked to market quarterly. So in contrast to what we've seen with some of the lighter regulated US banks, only the larger banks are required to meet this ratio. So again, it just reinforces the view that we're not likely to see, given banks are far more regulated, hold far more capital, to see this contagion really spread out, and regulators, and given what happened in 2008, are much better equipped if a financial crisis does continue to play out. So, but nonetheless, the episode does remind us we have to tread carefully during this period where we've seen an expedited rate of interest rate increases. It's the fastest increase we've seen in 40 years. It is inevitably going to lead to some pockets of stress in the financial system. So that's just something to be mindful of.